What do these numbers tell you about the health of China's corporate sector?
I would say I wouldn't worry too much of the myth of the PPI inflation, because if we look at some of the other data that already came out for September, they do point to better growth momentum in China. And overall, if we look at the set of inflation data today, I would say inflationary pressure probably is not really a concern for China. And looking ahead, if we look at the CPI inflation as well, we think that headline CPI inflation could soften further in the remainder of this year, mainly due to softer food price inflation. Given a high comparison base we had for pork prices a year ago. But overall, given the economy is recovering, we think other parts of the inflation complex, non-food inflation, as well as PPI inflation, would gradually recover as we go further into the recovery phase in China.
And that recovery is playing out in China's bond markets. We're seeing the yields above 3.2%. Is there a point at which the PBOC finds those yields uncomfortable? Where is the ceiling, do you think, for the central bank?
I think we need to look at the increase in yield in combination of the credit data we've got yesterday. So overall, I would say China's monetary policy still remains pretty accommodative. So we had a pretty strong upside surprise in China's credit growth. Even though we've seen some backup in terms of the yield, I think that's really partly also a reflection of how well the recovery has been ongoing in China. So I think overall the strength of China's economic recovery so far probably reduced some of policymakers' incentives to roll out additional easing. But we think it is too early to worry about policy tightening at the moment, given there are still downside risks to the economic recovery from a resurgence of infections. And also we're seeing some areas of the economy still struggling to get back to the pre-virus level, such as the services sector. So we think overall monetary policy stance will remain accommodative. And with that, we think the upside to China's yields is probably limited from here.
Right. So, Sylvia, David here. Let me just pick up on that then. You know, the two of the most common things that our guests tell us here in the shows when it comes to China is the weakest part of the recovery is in services, which you mentioned. The other thing they always tell us is when you look at the equity markets, you always look at the consumption story. You look at the services story, which those two things to me don't seem to come together as smoothly. How do you marry that fact that while that part of the economy may not be firing on all cylinders, why is the China consumer story still a buy?
So the way I would look at this is really looking at consumption in two different ways. So what we have probably more listed on the Chinese stock market is really on the goods side of the consumption, while the kind of slack we're talking about is more mainly on the services side of the consumption. So far, if we look at the retail sales data, goods side of the consumption is already back in positive growth territory. It's really the services side that is lagging. But if you think about the services consumption, say hairdressers, restaurants, they are not really that represented in the Chinese stock market. So that's why I think that divergence between the economy and the markets that we are seeing at the moment.
And what does that mean then for your tilts on, let's say, a multi-asset portfolio? We're obviously at the start, I would imagine, of a new credit cycle, not just in China, but globally as well. Does that mean I don't have really any other choice but to be overweight equity markets at this point?
Yeah, so on the asset allocation perspective, we do have a moderate risk on tilt in our multi-asset portfolio. As you mentioned, the policy is definitely supportive. And also we believe the global economic recovery is gaining traction. And we think the global economy has moved very swiftly from recession to an early cycle phase. That's why we are following an early cycle playbook where we're adding risk through overweight in equities and credit with a modest underweight to duration. And within the equity space, we do have a broad regional diversification where we overweight emerging markets and Europe to gain the cyclical exposure and leverage to China's recovery. At the same time, we are also overweight the U.S. equity market, given its high quality and defensive characteristics.
Sylvia, just briefly, what is the rationale that underpins your overweight call on emerging markets and Europe, particularly the constraints for central banks in EM?
So I would say there are several factors why we like emerging markets. Firstly, if you look at the index, it's very overweight North Asian equities, and we think that's the area we've seen pretty good control of the virus situation. So in a way, that gives us some defensiveness. At the same time, we think that weakening U.S. dollar trend is supportive of our EM equity outlook. And also, as we've mentioned, we're pretty positive on the outlook of the Chinese economy. And we think EM and EM Asia in general is pretty leveraged to that growth story.